It's about that time of day again, folks. Welcome back to your nightly newsletter, boys and girls. Joseph James here. It's Tuesday evening, January 26th, 2016. Boy, oh boy, markets are behaving pretty much as planned here. Big corrections today, but we are just getting started. Got big news tomorrow, big ranges in today's session. A lot of really interesting charts to look at. I'm not going to waste any time. Let's jump right in. Starting out tonight with oil. Crude oil is bearish after collapsing off today's highs. Yeah, check the chart, right? It just collapsed all the way off today's highs, which basically tells us to look for the next pullback to hold, for the bears to sell this sucker back to 29. We just saw a tremendous, look at the buyers completely walked away from the oil market. I think it's inevitable we're going to be back at those lows tomorrow. We're going to plan for tomorrow ahead of inventories. How about the S&P? E-mini S&P also very active today, a bullish spike in channel. But today's session ended with a trading range. Now that bullish trading range is going to tell us to look for bear traps. Traps at the highs, traps at the lows of the short-term range for the most reliable opportunities tomorrow. We get a big FOMC announcement tomorrow, so the S&P is going to be a big one. How about gold? The yellow metal is bullish and pulling back after a successful test of the channel highs, which tells the buyers to wait patiently for rotation back to the lows. We get a nice gap. We get an unfilled gap waiting down at the lows around the 15 handle for tomorrow on gold. Should be an easy one on gold, but we get an FOMC announcement tomorrow, so we'll see what the timing looks like on gold. How about the euro? The 6E is bullish after the buyers bought the correction. Didn't we call that a mile away? That was pretty easy, to be honest with you. Right? Bulls bought the correction off yesterday's highs, and now we're looking for profit taking at today's highs before the next opportunities tomorrow. Be looking for a two-legged correction on the euro, right? The next good buying opportunity tomorrow. Get a plan for the euro, gold, E-mini S&P, and oil for tomorrow. Before we jump into today's charts, though, I do want to remind you guys to make sure you're watching this video on our trading blog here at Sideways Markets. If you're watching the video on our YouTube channel, there's a link in the description of the YouTube video. That'll take you right over here to our trading blog for a few major reasons. First of all, I have an invite with your name on it to come out and grab a free pass to attend our live trade room as a guest. If you're not an advanced member here at School of Trade and you'd like to attend the trade room on a free pass, grab that in the upper left-hand corner. In the lower left-hand corner, you can register for our nightly newsletter mailing list. All I need is your name, your email address, and then check your inbox. I'm going to send you a verification email to make sure we have the correct address. And then let's see here, underneath the video tonight, almost last but not least, below tonight's video on our blog, you can download all the charts you see in tonight's video. How nice is that? And then over on the right-hand side, you can join up as a trial member. You can learn more about what it means to be a member here at School of Trade. And don't forget, we always have someone standing by 24/7, 365 to give you guys a hand. We get a busy day coming up tomorrow. Let's jump right into it here, starting out with our economic news for Wednesday, January the 27th. Now, the FOMC meeting began early this morning. I heard Yellen's an early bird. I couldn't tell you. But the reality is that announcement will be coming out tomorrow at 2 p.m. Eastern Time. Let's talk about this announcement for a moment. As the day gets later tomorrow, right about 11 a.m. Eastern Time, all the big players are going to be sitting on hands. Most smart asset managers, remember these are futures we trade, so they're going to be hedgers, right? Short-term hedgers for their clients, whatever the reasons are for their hedging practices. The bottom line is, though, after 11 o'clock, all the smart money will either be sitting on hands or they will be very well protected against any whippiness that comes out at 2 o'clock. What that means for us as little old day traders, the flies on the back of the elephant. Who are you calling flies, right? But the bottom line is we got the elephants in the market. I'm a fly on the back of the elephant, so I need to do what the elephants are doing. And so after 11 o'clock tomorrow, it is going to be gambler hour. It's going to be amateur hour until about 2 o'clock, until about 2:30 p.m. I always tell my clients early in, early out on an FOMC day after 11 o'clock, head to lunch. And then I got to be honest, you're gambling after 2 o'clock tomorrow. The reality is rookies, they look at the big whipsaw, the big volatility that happens after 2 o'clock, right, on FOMC, but there's something you're not seeing. You're not seeing a lot of volatility, but not a lot of liquidity. Price is going to jump. I'm telling you right now, this is the only time I'll say it, trading after 2 o'clock tomorrow is going to be dangerous to the health of your trade account. I always tell people, don't even dare putting real money on the line after 2 o'clock unless you've seen at least 6 of these FOMC announcements. They happen 8 times a year. Hopefully by the time you've seen 6 of these, you have tried on a simulator. And the hard part is that on a simulator, you're never going to experience that lack of liquidity that you will on a live trade account. So I hope you'll take my word for it. If you choose to trade after 2 o'clock, do it with somebody else's account, right? But don't do it with your own money tomorrow until, again, you've seen at least 6 of them, because, again, it's unprecedented volatility that comes out after 2 o'clock. And don't be fooled. That volatility, the knife cuts both ways, right? And remember, as human beings, losses hurt a lot more than winners feel good, right? On a 1 to 10 scale, a loss is a 12 for most human beings, whereas a profit, right, is probably a 7 to 8, right, on a 10 scale. So keep that in mind. Protect your capital. There are so many opportunities this week to make $1. We don't need to play during the hardest times, and don't be fooled by that temptation of extra volatility because liquidity is not there. Now, we talked about the FOMC. Now let's handle the Petroleum Status report tomorrow. Tomorrow is kind of a trader's holiday for crude traders. It's also an early in, early out. Most crude traders on Wednesdays will be trading until no later than 10:15, and then they're going to be sitting on hands until at least 10:40 after that news comes out. Now, just like the FOMC announcement, after that news comes out, you are in the amateur hour. You're in the gambler hour after 10:30. Yes, I know there's lots of volatility, but again, you can't replicate this on a simulated trade account. So you might be the best simulated trader in the world around these news events, but when you actually need a buyer to take your sell, it's going to hurt you. It's going to hurt you. Give it at least till 10:40. And again, if you want my advice, especially for anybody who's not consistently making profit already, this is not the time to be trying out your live account after 10:30 a.m., right, or 10:15, like I said. After 10:15, we're sitting on hands in our trade room for oil. We'll move to another market to finish up the morning session if we want to, but I think you're going to get plenty of opportunity ahead of 10:15 tomorrow. And then again, sitting on hands at 10:30, and then again after 10:30, it's really, really dangerous if you don't know what you're doing, so be careful out there. We got news here tomorrow morning at 10 a.m., 10:30, and 2 p.m., First news event at 10 o'clock, set the alarm reminder at 9:55. And so basically we're going to have a little window between 10 o'clock and 10:30. Right at 10:30, again, got to cut it for crude trading. And then I'll tell you, 11 o'clock is going to come really fast. This is just exactly why I say on an inventory day, on an FOMC day, get to it early, right? Get to that desk early, get a cup of coffee going, and make your money early, because the later it goes, the only people who are trading are going to be rookies. And just like driving at midnight, right? Nothing good on the road at that time of night. You start driving too late in the morning tomorrow morning, you're going to deal with the same troubles, right, that you would driving at midnight. All right, let's keep going. Moving forward here, jumping into crude. Look at this thing. Look at this market. Boy, you can't ask for much more than this. I mean, how much more do you want? Busy markets, volatility, lots of volume. This is what we dream of for day trading, and it's been a fantastic year so far. Crude oil is bearish after collapsing, literally collapsing. Look at that. There's that's one green candle in the entire move. When was the last time we saw something like that? Look at it. Little micro spike in channel that breaks through the low. Just a little bit bearish. What it feels like is those buyers saw the measured move completed. They saw their 3 pushes higher, and they said, okay, that's good to go. We got the correction from yesterday, and now we can finish possibly a monster, another leg down. At this point, it almost seems inevitable, pending any overnight developments out of China, right, out of the ECB, and of course ahead of the inventory report tomorrow. Pending any big announcement, any big changes, it almost feels inevitable that we're back at 29, right, by the time we get the inventory report tomorrow, or at the very least, we trade inside of a trading range until the news comes out tomorrow. So we're definitely bearish. you can't call this a bullish market right now, but as of an hour and a half ago, it would have been a bullish market. Pretty amazing how quickly it can turn on a dime like that. The bulls had control the entire session today with a channel, 3 pushes higher into an extended measured move before the 430 API number came out tonight, and price just collapses with some serious strength. This basically tells us the bulls walked away with their profit from today, and the sellers are left to finish the move back to 29. Sellers, you guys are looking for the next test of the moving average to hold, while the buyers will be looking to call your bluff. The buyers are looking for the sellers to fail at that next pullback, right, to make an attempt back to retest today's highs. Again, at this point, I would imagine, first of all, any buyer still left in this market has to be feeling really worried about this right now. And if they haven't gotten themselves out of this market, what a lot of times will happen is think about if you were a buyer, let's say, up around these highs. Maybe you're willing to let it go halfway back, right? And you're looking to let it go and then come back. Most buyers who are stuck in this trade, again, it's hard to imagine anybody's still in this trade long right now. But if you were still long either off the highs or really anywhere off this upper third, right? If you bought anywhere up here at the upper third, there is a chance that you looked left and said, you know what, I'm willing to hold it about halfway against it. Okay, now here's what happens. Price goes back up. This is where the buyer's break-even point is going to be, right? Again, think about it. Right? If they're buying here, they're buying here, they're buying here, they're buying all the way up, right? Very bullish scenario at the end of the session. Their break-even point is going to be right about there, right? So what tends to happen is when the buyers know they're beat, they're going to know that when price, because it'll come back eventually. This is just going to keep falling lower, right? You're going to see some profit taking. It's going to retrace off these lows. And what ends up happening is the buyers finally exit their position when they're in a lot better position than they were about an hour ago. And the reality is how do you get out of a long trade? You sell your way out. And that's usually why that retracement is greeted with so much bearishness. We have some major resistance areas overhead, and really at this point, for the sellers to feel confident with this, right, they're going to want to see that moving average hold, right, and then at that point, they pretty much know it's on down to that 29, right, which we started out the day from. Now, conversely, right, the opposite side of that is going to be if they fail, right? And that's what the buyers are going to be waiting for. The buyers are waiting here for those sellers to try to sell it. If they fail, probably won't be a buyer right into the failure. But then if they can hold that next pullback, that's where they're going to be looking for it. If they can hold that pullback after seller failure, again, you could be aggressive and buy the seller failure, right? It's probably going to be a little bit too early to tell at that point just because of the extreme bearishness. But again, sellers, you guys need to hold that pullback, right, to have the confidence to go lower. Pending this isn't happening right at 10:30 tomorrow morning. Remember, we got news tomorrow after 10:15. We're sitting on hands. If it holds that pullback, we're looking for the sellers to return back to 29s, right? If they can't hold that pullback, I mean, that literally is the dream come true for these buyers, right? If they can't hold it, your first opportunity here would be buying into the failure. I think you're too aggressive at that point. I'll wait to see a pullback hold and then look to initiate the long. Now, what may happen is we may see this, again, just assuming this extreme bearishness spooks all the bulls out of this market and gets a lot of just blind, what I call sledgehammer sellers. What that means is that with all this bearishness, right, even the newest of all new traders know to sell that moving average. And so even if we know exactly what should happen, right, we're still going to get sellers entering at that moving average, right? Just out of the sheer momentum of this market, that steamroller effect. That's why trading counter trend, no matter how smart you are, no matter how many good indicators you're using, right, they're all lagging, by the way, right, but it's going to try to sell at that moving average. So here's a scenario. We break back up, we hold the moving average, but we never make a new lower low. Look for this to be a trading range tomorrow because that's what you would kind of anticipate ahead of an inventory report. And then you throw in the FOMC, right? And now, of course, you've got yourself with a lot of analysis paralysis. So if we're making new lower lows after we hold that moving average, then we know the sellers really want it back to 29. If we see that double bottom after we hold the moving average, right, then you're looking for a trading range, which makes perfect sense ahead of the inventory report tomorrow at 10:30 a.m. Eastern Standard Time. Let's keep moving. Got a lot to cover here. How about the S&P? The E-mini S&P is bullish, but today's session ended with a trading range, which tells us to look for bear traps. Bear traps at the highs, bear traps at the lows of the range for the most reliable buying opportunities tomorrow. Now, today's spike in channel kept the buyers in control all day today, but the smart bulls are waiting for a bearish correction, most likely 2 legs and at least 10 candles for each leg before they buy into seller failures tomorrow. And we have that measured move waiting up there at 1910, a major resistance area up at 1915, which is just waiting for, right, which is waiting for these buyers to finish off that move. Now remember, we get a big news report tomorrow. What time is it at? 2 o'clock Eastern time. What's your cutoff time? 11 a.m. Why? Because we are the flies, right, on the back of the elephant. I'm sure it smells nice back there too. But the reality is that when the big money leaves the market tomorrow morning, right, they'll stop initiating new trades, and that's going to mean the only people buying highs and selling lows are going to be rookies, and those rookies don't exactly exude confidence, right, in their trading, especially on the S&P. So after 11 o'clock tomorrow, all hands off the mouse, right, all hands off the keys. We'll sit on hands. Usually what happens is we usually get a fluttering effect ahead of the news at 2 o'clock. So if we pull back, it'll usually start to really kind of flutter. It's pretty uncanny. You know, ahead of FOMC announcements, we do tend to get that almost blind bullishness. And a lot of it has to do with the fact of simply traders getting out of, right, short positions. And, of course, that kind of euphoria, right, that comes in those real quiet hours before that inventory or before the FOMC report comes out tomorrow. After 11 o'clock, I'll be sitting on hands, no initiating new positions, and protecting capital until after 2 o'clock. And then again, we've got that very dangerous environment that comes out after 2 o'clock on the FOMC announcement. All right, we got a bullish spike in channel this morning. 1, 2, 3 legs up. We didn't complete the measured move, and that's definitely what the buyers have to be looking at right now, right? We did not complete that measured move, and in my opinion, that means there's definitely some bulls still in this market, okay? Now, I'm not quite sure if I feel comfortable calling this the big measured move, right? We don't really know where it's going to go, but if this market does just take off like a rocket ship tomorrow after the FOMC number comes out, right, be looking for a bigger measured move. We're probably not going to get it before the news comes out tomorrow. But remember, that's the story on a spike in channel, right? Spike in channel, spike up, channel out. We're expecting a bearish correction back to the base of that channel. That should fool the sellers into trying to sell the next retracement. When it fails, we look to buy the failure. And of course, that takes us right into an A, B, C, and D, right? A, B, C, and D. It really all depends on what happens tomorrow. Will this happen before the news comes out? Will this happen after the news comes out? It really has everything to do with timing tomorrow. The bottom line, though, is it definitely feels like some of these bulls just took their profit, right, and left the building. But that lack of the measured move up there tells me there's got to be some buyers who are still lingering in this right now. And so that means we're looking for a deep correction. We've got correction zones back here at major support, right, around that 1870 area. Prior pullback around the 1880 area, right? And again, of course, with that trading range, right, we're looking at traps. The best trades on a spike in channel are going to come after a 2-legged correction. Fool those bears into thinking this is a bearish market. It's not a bearish market. It's just profit taking from the buyers. And then we're looking for those sellers to fail, right, to finish off that move higher, going into the measured move, and of course, that major resistance overhead. Don't forget, if we do break down below the base of that spike in channel, it'll be a mad dash down to the 1851 area to complete the full failure of that spike in channel, right? Goes back to the beginning of the spike. Now, real quick, you know how to trade a spike in channel, right? Look for a 2-legged correction, 10 candles each way, buying into seller failure, right? We'll wait for the correction to complete, and then we'll look for the sellers to fail for the buying opportunity. What if we stay inside this range? This is a really important topic to cover. We have a bullish trading range, right? A bullish bias into a trading range. We're looking for bear traps at the lows. In other words, looking for buyers to try to sell the low. Remember, we don't sell low, we sell high, right? Okay, price goes lower, bear traps the low. What if price goes higher? If price goes higher, this is the S&P, it's usually not going to be as easy as simply buying a pullback. But if we do see the moving average hold, right, and we get a nice signal candle on it, it will give us no choice but to buy that pullback, right, buying the pullback back to the high of that channel. That usually doesn't happen like that, though. It's not usually that picture perfect. What usually happens is we usually get a break higher, a collapse back down because most breakouts fail. Sellers now try to sell it. Yeah, we know that's where we're going to look for them to trap, right, and buy into their failure. So literally, you're looking for bear traps. Bear traps as we go lower and the sellers try to sell it. You're buying into their failure. Target back at the high. We go back up to the high. Again, if it happens to give you that picture perfect, right, nice green candle to buy that pullback, right, you can look to take it. That's usually not the most reliable trade there at those highs, though. Usually it's going to be the breakup, right, the failure back down, sellers try to sell it, right, and we again look for a bear trap to sell, to buy into seller failure. The bottom line is right now, I mean, literally, unless we see the sellers hold that pullback, even then we got a lot of support levels to worry about below. It's really difficult to find, well, it should be easy to find the proof. The sellers just have to hold a pullback, but it's going to be difficult to find room, right? It's going to be difficult to navigate through the low of the range, the buy zone, the swing, the major support, the spike in channel correction. Good luck. It's going to be difficult until we break below this 1867 area before you even get any glimpse of fresh air to get down to that low, right? If you're a seller, if you're going to be a seller tomorrow on the S&P, the best way to do it is going to be buyer failure, right? Pullback failures. That'll be the best way to do it. That'll at least give you some juice and allow you to sell down up off that low. How about some gold? Gold is bullish and pulling back after a successful test of the channel highs, which tells the buyers to wait for rotation back to the lows of the channel. We have a gap down there at 1115, right? Big old gap down there at 1115. See that right there, unfilled gap at 1115, which just so happens to line up perfectly right at the low of that channel. Now, we can see a measured move going higher, right? So measured move traders, smart traders will be taking their profit. Channel traders up at the highs of this channel, they should be taking their profit, right? Here's the one variable. The bulls only needed 2 pushes to complete the measured move today. So a third push may be coming before we get the correction lower. We saw this last week a few times. We need to keep an eye out for a possible runaway market up to a price magnet up at 1136.2 if the buyers really want to punch this thing higher. The most reliable buying opportunities will come back at channel lows. But without a third push here today, you got to keep in mind that's definitely open to negotiation for these buyers. So again, measured move up, channel rotation up. Again, most smart traders are taking their profit, or at least they're selling the high. I would never encourage someone to sell the high in a bullish market like this, right? I would definitely want to follow that trend, right? But again, it only gave us 1 push. 2 pushes, right? Maybe it's a second push in there, but it looks like we have 2 pushes higher here. And that leads me into a couple different scenarios. Let's play that game. What if price goes higher? What if price goes lower? If price goes higher now, this becomes a double press high at a bull channel high. Most traders see that as a gift from the trading gods. They're going to take more profit there, and that will result in kind of a snap back, right? And then we can buy it back at that low again. Again, we have that unfilled gap down there. Okay, so if we do just push higher here, again, think about this. This is an incredibly bullish market right now. And even if you didn't even know what you were doing, right? Even if you didn't know how to trade very well, you can look left and say, boy, this is a bullish market. I'm going to buy this pullback, right? That's the term I use to describe that runaway market, that steamroller effect. This is why you don't trade counter trend. never underestimate the power of a trend. You can do everything right, but because you're counter trend, again, even the newest of traders out there know, new higher high, buy the pullback, right? That's not going to stop just because you think we've already taken profit up there. So again, I would recommend if we do see these buyers, and again, it wouldn't surprise me at all, right? Buyers see it, they say, buy the pullback, let's do this. They buy the pullback, we make a third push higher. Then at that point, we got to take the pulse of the market. It may turn into a runaway market tomorrow because of what news? 2 p.m. FOMC. Right now, there's a price magnet all the way up at 1136.2. If this market runs away tomorrow, that's where you leave your final target. Okay, 1136.2. Again, it's a big runaway target. It's a good chunk higher here, but for gold on an FOMC day, it ain't that much, right? So scenario one is going to be we double press high, but we just keep on going. At that point, buy whatever you can get your hands on and leave that final runner at 36.2. What is more likely to happen, though, is this next pullback fails and we correct hard, right? Everybody takes their profit after that second push high. Again, the second push high to most traders is just a gift. It's easy money. They take their profit, and of course, the sellers see it. It has a self-fulfilling prophecy to it, and it snaps back lower. Then we want to be a buyer, right, down around these lows. Now, we assume that price will continue with profit taking, right? Let's say we go lower. We have a gap to fill down here, 1115. We want to get back to that channel low. Most reliable trade as we go lower is going to be buying into seller failure, right? Rinse and repeat over and over again at those channel lows, right? Even if it pushes even lower, even if it pushes even lower than that. Wait for those sellers, try to hold that pullback. If they fail, right, we go higher. Now, what if they do successfully hold that pullback? Look for the low of that channel to act as resistance, and then look for the bears to make a run back to this little congestion area here, which also happens to be major support right around this 1106, 1105 area. Right? So again, the most reliable buying opportunities back at the low of that channel. If it takes off to the upside, look for that double press high and the collapse back down. If it keeps on going, you know the story. 1136.2 is going to be that runner target here tomorrow. Just make sure you're careful getting into positions around that FOMC announcement. Again, don't be foolish. There's so many opportunities to make money. You don't need to gamble around news. Last but not least here, wrapping up with the euro. The euro is bullish after the buyers bought the correction off yesterday's highs, and now we'll look for profit taking at today's highs before the next opportunities tomorrow. Just as expected, the buyers got long after the head fake at 8,400. We called that a mile away, and now we see the target back at the range highs is almost tested, which should result in profit taking before the next leg higher. Buyers will look for a two-legged correction after we test resistance. The key word there is after we test resistance overhead before buying more. And sellers need to see a lower low, and they got to hold a pullback to even consider being a bear right now in this market. This is going to be one of those markets that will be kind of by a roundabout way affected by tomorrow's FOMC announcement. The FOMC announcement will have a big impact on the dollar. The dollar, of course, is an index. The biggest unit of that index is going to be the euro. The euro makes up 60% last time I checked, right? Over half of the dollar index is made up of the euro, right? So the dollar is going to be the dog tomorrow, right? That shakes the tail. The tail is gold. The tail is euro. And so this will definitely be a big impacted market tomorrow. Very difficult for me to say being a bear right now in this euro. It's acting exactly like any bull would want it to. Yesterday, we saw exactly what we expected today, right? Yesterday morning or yesterday evening, we saw the measured move. We expected a bearish correction, right? A little head fake down around 8,400. That was easy. Sellers tried to hold the pullback. They failed to hold that pullback, and every buyer and their brother-in-law is jumping in long after those sellers failed to hold that pullback, right? That's a great example right there. Sellers try, sellers fail. If they would have been successful there, right, sellers would have jumped all over it and made a run back at that low. But again, seller failure, buying into that failure, just beautiful, picture perfect. Now you can see 1, 2, 3 pushes higher. We know the immediate target overhead for the bulls is to go back to that high. Once we get to that high, I'm looking for a two-legged correction, then into seller failure for the next leg up to complete that measured move higher. And again, you'll notice here, it's a big old measured move higher. Multi-day measured move is going to be your long-term target here if you're a bull here with me on the euro. What about being a bear? Right? What about being a bear? Well, there is potential this may end up being a range ahead of the FOMC report tomorrow. I can't even really talk about being a bear, though, until we go lower and hold a retracement, right? If we can hold or hold a pullback, right? Whatever you want. It's technically called a retracement when it goes lower, right? If we hold the pullback, new lower low, hold the pullback, then we know those sellers are going to be targeting the range low, right? They'll be targeting major support, 8,200, right? 8,000, so on and so forth. But again, this market feels very, very bullish unless these buyers completely walk away from this right now. Wait for the proof if you're a bear, right? If you're a bear right now, wait for the proof. If you're a bull, be patient for that two-legged correction after we hit that high, and then look to buy into those seller failures. Rinse and repeat, rinse and repeat. Guys and gals, awesome work so far this week, and we are just getting started. Tomorrow's a really busy day. Inventories at 10:30, FOMC at 2 o'clock. Get to it early. Get out of there early with your money in your account, and then batten down the hatches. I don't care whether it takes handcuffs, a cattle prod, duct tape, right, or a good old trading buddy to keep you from over trading and gambling tomorrow afternoon. So be careful out there. Last but not least, don't forget, join the free trial on our website here at schooloftrade.com. We have beginner, intermediate, and advanced levels of membership, and I always have someone standing by 24/7, 365 to answer all your questions. My name is Joseph. Thanks for being here tonight. Thanks for sharing this information with a friend. Thanks for giving me a thumbs up on the YouTube video. And of course, don't forget, come back and see us tomorrow, 8 a.m. tomorrow morning. We open up our trade and do it all together tomorrow night for a Wednesday edition of our nightly newsletter. Now get out of here. Go finish shoveling your car out, right? What a beautiful day, though. A lot of sunshine around the country today. Hope you guys are doing well out there. Hope everyone stayed safe over the weekend. Have a great evening. Rest up. Be well out there. Be nice to each other, will ya? And be here in the mañana. Adios, amigos. Bye-bye for now.